Good evening, students. We'll wait for 2 minutes so others can join. Okay, then we will start. Are you guys able to see the PPT? Please confirm, then we move forward.
Yes, sir.
Okay, thank you. Uh, uh, so from last two sessions, we find in the international finance, okay, we learn, we can say the what is international finance, uh, what is the definition of international finance, we can say what are the different we can say what are the different participants in the of the international finance. Okay, what are the different factors which have the effects on the international trades. Okay, how the financial transactions across the borders were done, and we can say what are the uh, how the we can say the regulatory bodies, different regulatory bodies like the World Bank, the IMF, the we can say the central bank of the different nations, how these bodies regulate the international trades. Okay, and we also learned that what is the need to the finance students to learn this subject, that is international finance, why this subject is very much important. Okay, so we learn all these things in the last session. If in the last sessions we also see the some scenario, that is the gold standard system. Okay, or we can say the Bretton Woods systems. Okay, so we learn these systems in the we can say in a short manner. So in these sessions we learn all these aspects in we can see in a wider way. So in these sessions we understand the international monetary systems and the key financial institution who plays the major role in the international finance. Okay, we also learn the credit rating agencies, and we can say the role of the credit rating agencies and why the credit rating agencies are important, why their ratings is important from the investor's point of view, or why their rating is you can say important at the international level. So all these aspects we are going to learn in these sessions. Okay. Uh, we can say we first see that is the foundation of the international monetary. systems. What are their core functions, and we can say what are the key components of the international monetary systems. First, we understand what are the core functions of the international monetary systems. First one is, we can say, the international monetary system, we can say, the facilitating the international payments. As I told you that whenever the international trades happen, the payment across the border payments were done through the, we can say, the electronic devices. Okay, so these electronic devices through, we can say, the commercial bank from the one nations to the other nations. So this commercial bank is authorized or gets the approval from the central bank of the respective nation, and then only this commercial bank is able to do the, we can say, the international payments. So all these, that is the central bank, the commercial bank, all these are the part of the international monetary systems. So with the, we can say, by we can say, converting the one currency into the other currency with the help of the exchange rate, uh, these banks make the international payments. So the international, we can say, international monetary system facilitate the international payments. So because of this facility of the international payments, the international trade is easy. Across the border trades are easy. So next one is, we can say, they provide the exchange rate in exchange rate stability. So the international monetary systems, okay, who provide the, we can say, the stability in the exchange rate at this some of the level. But the, we can say, the most of the time the exchange rate, it depends upon the demand and supply of the different economies. But we can say the some of the bodies has kept some control on the exchange rate. Number third is, that is ensuring the liquidity for the global trades. As in the last sessions, yesterday I told you that the some of the financial institutions at the international level provides the funds for the international businesses. Okay, they make the, we can say, investment across the border, investment uh, uh, in the other countries, that is the foreign direct investments. Okay, so we can say that's why they ensure the, we can say, the cash requirements in the business at the international levels. They ensure the, we can say, there is a no, we can say, lack of the liquidity or the money, due to which the many of the times the businesses may stuck. So the international monetary systems ensure the liquidity for the global trades. Now next one is, we can say, the promoting adjustment of the balance of payment. Okay, so the international monetary systems helps in for the balance of payment. Now what are the key components in which the international monetary system helps? First one is the exchange rate mechanisms. Okay, so the exchange rate, we all know that the international monetary system is the complex systems. It is the group of the international bodies. It is a group of the central banks of the different nations. It is the, we can say, it is the, we can say, the combination of commercial banks in the different nations. So they, we can say, they set the exchange rate mechanism. Okay, they reserve the assets and currencies. Okay, so we can say the international monetary system reserve the uh, currencies in the form of, we can say, whenever they require the to make the payments at international level, what we call as the foreign reserve. Okay, so the RBI of in India kept the foreign reserve. Same likewise, the international financial institutions are also the key components of the international financial systems, and the rules and conventions, which are made by the different international bodies and the central banks of the different nations. Okay, so, or we can say, the geopolitical groups. Okay, they also made the different rules and convention for the international trades. As we all know that there are the different geographical groups, that is the European Union, NATO, we can say the South Asian countries. Okay, so the Russia has their own groups. So all these are, we can say, the geopolitical groups. So they make the rules and conventions for the across the border trade. So all this is the part of the international monetary systems. Now we are going to understand. So uh, what we can say yeah, in the last sessions also I told you that is the need of the across the border trades were increased after the we can say the World War II, because after the World War II we can say the devastation we can say of the World War II categorized the unprecedented international economic cooperations, because the world economy is at the very slow pace. The countries like some of the European countries like the UK, who actually colonized half of the world, but after the World War II, they had the huge monetary losses. Some of the countries like Germany, some of the countries like we can say Japan. So all these are the developed and we can say the rich countries at the time of the World War II. But we can say the because of the conflicts and because of the war, these countries have a huge monetary loss. So at the international levels, the world leaders think that now it's the we can say the acceleration of the we can say development of the world economy. So what they decide, we can say with the globalization concept, that is the liberalization concept. That is, they thinks that the need of the increase across the border trades, and then only the world economy can develop at the we can say the fast pace. So they came up. After the World War II, we can say the across the border trade gets increases. So now, while doing the we can say the trades at the international levels, how they make the payments? It is the big questions in the every nation's mind. So first, we can say the Bretton Woods systems. We can say came into the force. We can say the conference in the New Hampshire, where the 45 allied nations of America gathered for the new financial orders. Now, what they decide to make the international payments, they want some uniform systems. So, for this, what they do, the currencies, we can say, they we can say the fixed exchange rate, what they decides in that conference. Okay, so in that conference, what they decides the value of the dollar, that is the 1 ounce of gold, that is the 1 gram of gold is equal to the $35. That means, uh, that means they decides the value of the dollar fixed with the we can say the quantity of the gold. Okay, so with uh, with the same value, the every country pays make the payments to the other countries. Okay, so this we can say these systems were continue up to the 1971. But what the America found in after the some point of time, the value of their dollar is less, but it may be higher because of the demand of the US dollar on the international level is higher, because the Indian we can say the US economy is dominating the world economy. So the every nations accept the payment in the US dollars. So those so dollar as we can say used as a reserve currency by each and every country. So the America's economic might and the gold reserve established the dollar as a backbone of the international finance. So dollar becomes we can say the international currency in a very we can we can in a very fast pace. Okay. So after that decisions, okay, after the Bretton Woods conference, the creation of IMF and the World Bank to supervise the systems and the finance the reconstructions. Okay, in the same conference, that is the decisions were taken by the 44 allied nations, that is the establishment of the World Bank and the IMF. Okay, to we can say have the development of the world economy. Okay. So these systems continue. That is the fixed exchange rate. That is the $35 is equal to the 1 ounce of gold. That system continues till the 1971. That means the each and every country make the payment in the gold as if in the gold. That is the 1 ounce of gold is equal to the $35. Okay, that means if the any country have the gold, so they can make the payment of the as equivalence to the dollar. Okay, but what happened? We can say the availability of the gold gets decreases over a period of time. Each and every country don't have the gold to make the payments. Okay, so they starts to make the payments in dollars. So now the what America thinks that their dollars value, that is $35 is equal to 1 ounce is less. They deserve more value. Okay, so in 1971, there is one we can say president of US, that is the Richard Nixon, who unilaterally, that means he we can say breaks the Bretton Woods decisions of $35 is equal to 1 ounce, and he unilaterally terminated the dollar gold convertibility. That means he announced that from onwards, that is the $35 is equal to 1 ounce. We can say this system is we can say is not there, so the US gold reserve depleted and inflation rose. Okay, so what he came up with the systems. Okay, he wants the floating exchange rate. That means the dollar values decided by the we can say the demand and supply of the dollar on the international level. So in Jamaica agreement in 1976, they formulated the transition to floating exchange rates, giving the central banks the more monetary autonomy. So from onwards, from the 1976, the dollar value is decided with the other currencies based on the demand and supply on the international level. So the shift to the floating rate fundamentally transformed the global economy. That is creating both the opportunity and challenges. Okay, so from the fixed rate to the floating rate, okay, so they creates both opportunity for the some of the nations and the challenges from the some of the nation, because the rate of the dollar automatically gets increases. That means if the any country wants to pay some amount to the other countries, now they has to pay the same amount on the floating exchange rate. Okay, so they may we can say that increase the risk, that is the payment risk. Okay, so whenever there is a price of the dollar gets increases, then the country have to pay a more amount. So this we can say the challenge in every nations ahead. Okay, but also the greater flexibility for national economies to adopt the changing condition without sacrificing the domestic policy. But every nation has to accept the system, because we can see the US economy and the US dollar is dominate at the international level. Okay, so that's why that's why we can see the floating exchange rate accepted by the each and every nations, and this starts to make the payments in the dollars. So the evolution of the international monetary systems, we can say from fixed to floating, the transformation of how nations manage currency relationships has the responded to the changing economic realities, technological advance, and the shifting of the power dynamics. Okay. So as we all know that at that point of time, there is no other competitors to the US, because as we know the USSR, that is that is the Russia now, Russia breaks into the 15 to 16 nations, and also now there are options available to the other countries. So that's why this evolution in international monetary systems were happened. Okay, so now to we can say the US dollar indexing dominance and the emerging challenges. Okay, so in the recent times, as we know that the some of the economies face challenge to the US economy now, the China is growing at very fast pace from the 1990s. China is growing, we can say, near about at the 10%, near about the 10 to 15% rate. Their GDP increase at the 10 to 15. India is also we can say develop at very fast rate at near about the 7 to 8%. Okay, so now the China, India, so all these are the part of the top five economies. Okay, but we can say the still the US economy is, we can say, is more ahead of the China and the Indian economies. Okay, so now we can say, despite the predictions of the decline of the US dollar, okay, we can say U- US also, we can say the US is not, we can say, progress, is GDP is progress at very low rate, that is the 1.7% only. Okay, as compared to US economies, the Chinese economy and the Indian economies is, we can say, grow at near about the 6 to 7%. Okay, but despite of that, US dollar has maintained its position because it's, we can say, the much ahead of the Chinese and the Indian economy. Now the Chinese and the Indian economies may require the 10 to 15, 20 years to, we can say, to cope up with the American economy. Okay, so because so the world's, we can say, the preeminent reserve currency for last 75 years is the US dollars. Okay, so from last 75 years, the US dollar dominate the world market. Okay, uh, so the dollar, so we can say, and due to this, we can say, the some of the US leaders shows the ego to the world. So there is a one US Treasury Secretary. Okay, that means he is the, we can say, is the same authority as the RBI governor, who said in the 1971 that is the dollar is our currency, but it's your problem. Okay, because he knows that if the any country don't have the dollar in their pocket, in their reserve, so they are not capable to make the international payments. So that's why he said that world, that is the dollar is our economy, but it's your problem. That means you want the dollar to make the international payments. Okay, so dollar dominates the economy near about, we can say, the 58% global reserve. Okay, that means the every central bank of the every nations reserve the foreign currency to make the international payments. Okay, so the 58% foreign reserve of the different central banks of the nation is in the dollar. That means near about Indian RBI reserve the 60 million, we can say, the US dollars. Okay, same likewise the 88 percentage foreign exchange transactions are done in the dollars. So it is a very huge number. 88% is means near about 90%. Okay, so the 60% the global debt. Okay, the that means the loans, advances, and the all these things. That is the 60% global debt. We can say the denominated in dollars. Okay, so it is very huge number. That from that we can conclude that dollar is still is a dominant economy in the world. Okay, so dollar, we can say, dollar at the center in still in 2015. Okay, so still now the dollar is, we can say, the major uh, uh, currency for the international payments. And why? Because the deep financial markets, that is the US, we can say, the treasury market remains the, we can say, the a very huge market. This is a very liquid market near about 26 trillions, we can say, in outstanding the securities and providing the safe haven. Okay, and so due to that, that is the trade dominance. Also, the American market dominates in the trade. That is the major commodities, like the oil is still priced in the US. That means the oil prices or the energy prices on the international level were decided in the dollars. Okay, so with, we can say, the 80% of the global trades invoice in the US, despite the diversification effort. Okay, the some of the countries, that is the some of the competitor countries of the US, like India, China, Russia, we can say the Brazil. Okay, so all these are the, we can say, the competitor nations of uh, America. Now they try to diversify, we can say, the payments from the dollars to in the other currencies. But we can say it is not a easy task. Okay, so it is, we can say, the long way to go to wait for a certain period of time, and then only it will happen. Okay, so the network, we can say the effect. Okay, so so the dollars network dollar payment system is already well established financial infrastructures, and so that's why the dollar is at the center in 2015 also. So we can say the we can say to break the dominance of the dollar at the international level, the sum of the we can say the fragmentations and the geopolitical we can say we can say the alliance who are, we can say, taking, we can say, trying some fragmentations. Okay, to for what to we can say break the we can say the dominance of the US dollars. Now next we can say the global financial fragmentation we find in 2015. That is, we can say the one system is the Western financial sphere. That means they are, we can say, the dollar-based transactions. They are doing the payments in the dollars. Now there is the, we can say, the alliance of the five top developing nations. That is the Brazil, Russia, India, China, South Africa. That is the BRICS. Okay, so they also trying some we can say the alternative systems. They want now the alternative systems. They want to break the dominance of the US US at the international level and their currency dollar at the international levels. Okay. Okay, so the alternate systems trying a digital yuan payment uh, corridor. So yuan is the, you can say, the currency of the China. Now the China wants we can say to make the payment international level on their currency, but we can say the Western financial sphere are we can say doing their payments in the Swift payment system. The Swift means that is, we can say uh, the worldwide interbank financial telecommunication. So this with these systems, the Western financial spheres doing the payments. Okay, so now the we can say now we see the dollar we can say as the major economy at the international level. Now we will the some of the we can say international bodies who regulate the trade at the international levels. How they helps for the different rules, regulations, and how they helps at in the balance of payment, and we can say at the across the border financial transactions. So first one is, or how they help in the trades, how they help in the, we can say, the FDI, foreign direct investments, capital flows, in all these things. So the International Monetary Fund, that is also we called it as the guardian of the global stability. So IMF actually work for the financial stability at international levels. Okay, so that body established in 1944 in the Bretton Woods Conference, in the same conference in which the fixed, we can say the fixed exchange rates were we can say decided in this in that we can say in the same conference, that is the IMF were established, and the motive is to focus on the exchange rate stability to become the central institution for international monetary cooperations and the crisis management. Okay, see, one of the major motive of the IMF is the financial stability on the international level. So whenever there is the financial crisis in any nations, or we can say the payment crisis, or we can say the foreign reserve is not there at any nations. So at that point of time, the IMF provide the funds in the crisis to that nation, so they can fulfill their we can say the currency requirement to make the payments. So these are the motive of the international finance. We also see the core functions of the IMF. So IMF actually is doing, that is the surveillance. Okay, so IMF monitor the world economy. How is more world economy is developing, what is the rate, and they also monitor the economies and the financial policies of their all the member countries, that is the 190 countries. Okay, and also they advise the providing the policy, we can say they provide the policy advice. Whenever the IMF provide the funds to the any nations in their financial crisis, the nations cannot invest that fund without aid and advice of the International Monetary Fund. So the International Monetary Fund advise to that, we can say, nations, okay, to come out of that financial crisis. So surveillance is, we can say, one of the most important function of the International Monetary Fund. Now next one is the lending. Whenever while doing the surveillance, the IMF find out that the nation, one of the nations is in the financial crisis. Now, at that time, they provide the financial assistance to the countries experience the balance of payment difficulties. As we know, in 1991, India is facing the same issue, that is the balance of payment issue. That means we have the dollar reserve, that is the foreign currency reserve, of near about the 1 week, that is the say 8 to 9 days. That means we have that much foreign reserve dollars that we can buy the oil and the other requirements for 3 days. Okay, so that means we were in the financial crunch. We were in a financial crisis. So in such a situation, okay, so the countries don't have the enough foreign currency to make the payments for their oil requirement, energy requirements. Okay, at that point of time, the International Monetary Fund lent the funds to such a type of, we can say, nations. Now, next, third one is the capital management. Okay, so IMF also helps the countries to build the effective economic institutions. The institutions like, we can say, the investment banks. Okay, so their banking structures, insurance so in all this sense, they we can say helps the countries for the capacity development. Okay, so now currently the International Monetary Fund is led by the managing director, that is the MD, that is the Kristalina Georgieva, and is governed by its the 190 member countries. That means the every nation's member represent the IMF. Okay, so the, we can say, the governor of RBI is, we can say, is he always a member of the International Monetary Fund. Like such, the every country nominates the one of the members to the IMF, and we can say the 190 members plus the MD, who work, we can say, uh, consistent the board of governors. Okay. And the, we can say, the 24 executive board. So all this is work for the, we can say, the well-being of the world economy, that is the IMF. Now what is the IMF roles? Okay, uh, we will learn now what is the IMF role in, we can say, in 2015, how IMF works. Okay, so the IMF first role is the, we can say, the asset valuation concern, that is the persistent high valuation in equity and the real estate market despite rising the interest rates. Okay. They also, we can say, leverage the financial institutions. They provide the advice to the financial institutions. Okay, we can say, they, we can say, they the financial institutions then can, we can say, helps their nations to, we can say, make the huge investments, to provide the funds, okay, to have the financial stability. Okay, we can say the sovereign debt stress. Okay, so the IMF provide the funds to some of the poor and the developing countries at what times, we can say, in the, we can say, the balance of payment crisis. So over the 60% of the low income countries at the high risk of already in the debt, it stress requiring the coordinated restructuring approaches. So in such a conditions, So IMF aid and advice to such nations, and also they provides the funds in their financial crisis. So this is, we can see, the main role of the IMF in 2025 or at the any point of time. Now the IMF, we can say, now next one is, that is the next body is the World Bank. Okay, so the World Bank is also established in 1944 along with the International Monetary Fund at the Bretton Woods Conference, and the World Bank Group has involved the five institutions focus on the sustainable development. Okay, so IMF, which actually provide the funds in the situation of the financial crisis, in the financial crunch, or we can say the inability of the payment. Okay, and they provides the aid and advice also. So the World Bank plays some of the little but different role from the IMF. Okay, so they focuses on this sustainable development. That means they keep in mind the environment well-being, and they also keep in mind the overall economic development of the world economy. Okay, they also work on the poverty reductions through the financial assistance, knowledge sharing, and the policy advice. Okay, so they are also we can say the provide the little bit financial assistance, but their main motive is the, we can say, uh, poverty reduction, sustainable development, education, build the infrastructures, okay, health infrastructure, education infrastructure. So all these, we can say, the part came into the World Bank. So what are the different banks of the we can say the group of the institutions in the World Bank? Okay, so the first bank is the International Bank for Reconstruction and Development. Okay, so what these financial institutions of the World Bank do, they lends to the middle income and the credit worthy low income countries. The countries such as some of the poor African countries, some of the some poor Asian countries. So to that nations they provide the um, we can say funds uh, for their instructions to build infrastructures, and to help them to have the acceleration in their development. Okay, now next institution is the International Development Association. They provides the interest free loans and the grants to the poorest country. Okay, so the motive of this bank is to, we can say, to provide the, we can say, uh, the poor countries taken out of the uh, we can say the poverty. So they provide the interest free loans to build the infra, we can say, to different businesses, okay, to create the employment in their nations. So these financial institutions is International Development Assistance. Now the next institution is International Finance Corporation. They focuses on the private sector investment in developing countries. That means the International Finance Corporations, they provide the loans to the private corporations or the companies. Okay. So the companies can, we can say, start the business. They provide the employment to the nations. We can say they create some goods and services they can sell. So the number of economic activities in the nations is automatically increasing. And due to this, we can say the development in the nations is accelerated at the highest pace. Now, next one is the multilateral investment guarantee agency. That is, they offer the political risk insurance to the investor. So it is actually is the agency who provides the insurance whenever there is, we can say, now some of the countries they are having the political risks. The countries such as the Bangladesh, some of the countries like Afghanistan, Iran, Ukraine. So these are countries which are having the political risk. So whenever we invest, whenever the any financial institution, the big investor invest in such countries, they can take the insurance from these institutions. That is the multilateral investment guarantee agency. Now the World Bank's missions and what are their priorities in 2015. Okay, so the main two goals of the World Bank is the end extreme poverty. Okay, so when the World Bank established in 1944 in the we can say the Bretton Woods Conference, at that time also their main goal is to we can say to reduce the poverty. Okay, now their goal is to reduce the global extreme poverty to less than 3% by 2030. It is the goal set by the World Bank, and they promote the share the prosperity. Okay, so they we can say uh, that means what they thought, that is whenever there is the we can say the prosperity of the world economy. Okay, say so the poor and the poor country, developing country, okay, has to share. They promote the we can say shared prosperity. Okay. So they foster the income growth for the bottom 40% in every country. Okay. Now, what are there we can say the priorities of the World Bank? We know that is we see in the last slides that is the main motive of the World Bank is the sustainable development. That means World Bank wants the economic development at the of the world economy, but not at the value of the environment, not not by giving damage to the environment. So the we can say the World Bank wants the development with the sustainability. That is the we see the three factors that is the ESG, that is the environment, social, and the governance factor. Okay, so that's why the World Bank we can say emphasizes the green finance. That is means the business which don't have the adverse impact on the environment. And that is so that's why for the climate finance, the we can say the 25 billions dollar annually uh, we can say the provided by the World Bank to we can say have the sustainable development. Now next one is there we can say the main priority is the digital transformation. Okay. So the World Bank emphasis on the broadband access and the digital skill development. In the we can see the poor and the poorest nations also they provide the funds for these things. That is the digital we can see the transformation. Next, their priority is the human capital. Okay, so they wants to provide the education, well education for each and everyone. Okay, so that's why the World Bank provide the loans for to build the infrastructure in the poorer countries. They want they we can say provide the funds to build the health infrastructure, that is the healthcare facilities and the social protection systems. That is we can say the basic we can we can say the human rights. That is the protection of the human rights. Okay, so for that purpose, they provides the funds. Now, we can say the next main priority of the World Bank is the debt sustainability. That is, they want the transparent lending facilities and the we can say the restructuring framework. That means that means the any organizations who are taking the loan, okay, so we can see there is a transference process. Okay, so if the process is not transparent, okay, so we can say there may be the financial instability. But what the World Bank wants, that is the debt sustainability. Now the World Bank is increasingly leveraging the private sector partnership through the innovative financing mechanisms. That means the World Bank is doing the partnership with the some the private firms, okay, and to do some innovative financing mechanism like the we can say the uh, blended finance guarantee and the result based approaches to maximize the development impact with the limited public resources. That means by uh, cooperating with the we can say the private sector, private sector by using the limited public resources. That is the by using the limited funds of the governments with the help of the private sectors. Now, the World Bank wants to build the big infrastructure in the some of the developing and the poor countries. Now, next one is the World Bank in actions and the development impact. What is the impact of the World Bank on the development of the different nations? Okay, so the World Bank, we can say, start the integrated rural development project in the nation that is the Tanzania. If you see the example in the photograph, you will see that the country is the very poor, and the World Bank provides the funds to build the infrastructures. If you see there are the solar panel in front of the lady. Okay, so the we will see some of the components and what are the results of that components in the we can see the nation that is the Tanzania. Okay, so the we can say 5 megawatt distributed solar mini uh, grid networks. Okay, so World Bank we can say distribute the 5 megawatt solar mini grid networks. What is the result? The agricultural productivity increased by 37%. Okay, so because of the irrigation facilities, we can say uh, are increases because of the solar panels. So they automatically the agricultural productivity increases. So what happened when there is an increase in the agricultural productivity? Okay, so the people have the enough resources, enough income. Okay, so the automatically the poverty we can say the reduces. Now next one is the digital payment system for the 15,000 small holder farmers. So that's what is the result? The household income rose by the 28%. So the some of the such a type of project are run by the World Bank. Okay, so to reduce the poverty, to have the development, to build the infrastructure in the developed poor and the developing countries, like the education infrastructure, healthcare infrastructure, agricultural infrastructure. So all these things were done by the World Bank. Now we see these two bodies. Now the we can say the one more agency is having the more impact on the international level, that is the International Credit Rating Agency. So these are the credit rating agencies who rate the different we can say the government of the nations or the multinational corporations. Okay, so they use the rating. Okay, if the rating is good, that means the financial position, financial reporting. Okay, so all is good in that organizations or in that government. If the rating is low, that means the more financial fraud there in the government or in the multinational corporation, multinational companies, in the organization. So the credit rating agencies serve as the we can say the critical intermediaries in the global financial market who assess the credit worthiness of the sovereign government. Okay, so the credit rating agencies, what they do, they rate the we can say they do uh, credit worthiness of the governments, corporations, and the financial instruments. Okay, so on that basis, the different stakeholders can take the different decisions. Okay. Now we can say their judgment express as that means the credit rating agencies gives the graded system. That is, if they give the good grade, that is the AAA, that is the highest grade. That means the credit worthiness of the government or the organization, the multinational company is good. That means if the investor invest in that, we can say in the bonds issued by that government, or we can say the shares of that company organizations, or we can say the treasury bills of the government, then definitely they gets the good return. Or we can say the default risk is minimum in such a type of investments. But if the credit rating is low, so at that point of time, it is we can say it is the red signal for the investors, because if the credit worthiness of the government or the we can say multinational corporations, any company is less, then it is the, we can see it is the risky investment. Okay, so the default risk is associated with such a type of investment. Okay, so what are the different credit rating agencies? That is the, here is the, we can say see some of the credit rating agency, that is the Standard and Poor, that is the S&P, which established in 1860. Okay, so near about we can say this near about the 200 years ago, from a very we can say from a very old period, that S&P is working in the we can say the credit rating uh, as a credit rating agency. Now, second credit rating agency is the Moody's, which founded in 99, covers all the 11,000 corporate issuers, and they work in the 135 countries. That means they almost cover the 99% of the countries and the 99% of the companies and the corporations in the world. Now, next one is the fintech rating that created in 1914. Okay, and their headquarter is in the New York and the London. Okay, so they also give the uh, so what is the role and influence of the credit rating agency? If the credit rating agencies were not give the good, we can say the rating agency to the any government or to the any organizations, we can say the credit agency have the power to make or break the economies with the stroke of the pen. Okay, so with the help of their a single rating, the any organizations or the any government, we can say, will have the financial troubles, because the investors and the different stakeholders have their reliance on the credit rating agencies. Now, no, we can say now we find it out the challenges and the call for reforms. Okay, so what are the challenges in the credit rating agencies? Is the some of the times, okay, and what the reforms now were required in the credit ratings. Okay, so the first point is the conflict of interest. Okay, so in some of the times, what happened, the governments or some the powerful multinational companies, okay, so we can say they we can say paid we can say they pays the amount of money for the fake agencies, okay, to we can say to have a confidence of the investors and the different stakeholders in their government or in their uh, companies. So it is, we can say, the conflict of interest, and because of that, the different stakeholders may have the wrong informations. So it is one of the, we can say, the reforms, one of the challenge. Now next one is, we can say, the transparency concern. Okay, so how the credit rating agency do all these things, how they rate the different governments, different organizations. So this methodology, we can say, is lacking the methodology were not published. Okay, so the methodology details often the opaque with the subjective factor influencing rating decision. So the rating agency itself knows how they rates the different governments and the different multinational companies. Now, next one is, we can say, the regulatory reliance. That is the rating agencies embed in the financial regulations and amplifying their, we can say, market impact. Okay, so whenever the rating agency gives the rating to the any organizations, so automatically it followed by their impact on the markets. So next one is the market concentration. Okay, so we can say the some of the credit rating agencies, we can say these three, as we see, that is the S&P, Moody's, and the fintech rating, which controls the 95% of the market, and the other rating agencies will have only the 5%. So this is the major challenge. Okay, now what the reforms required in the credit rating agency, that is the enhanced governance, that is, we can say, the separation of the commercial and the analytical function to reduce the conflict of interest. That means the analytical and the and because of the commercial and the analytical functions together, okay, so that may followed by the conflict of interest, because some of the governments and the multinational companies, we can say may make the frauds. They provide the funds, money to the uh, credit agencies to have the good rating. Now the we can say ESG integrations. Okay, so the credit rating agencies should follow the ESG, that is the environmental, social, and the governance. They must analyze the ESG factors. If the government or the any corporations follows these ESG norms to, we can say, have the sustainable development or not. Okay, so all these reforms required in the credit rating agency. Okay, now we'll see the future of the international monetary and financial systems. Okay, so what is the future of the international monetary system? That means how in the future the payments on the international levels are going to happen. Okay, so the international monetary system, we can say, stands at the crossroad, because why we called it stands at a crossroad, because now we follow, we can say, the traditional methods also, the advanced methods also, the digital transformations are, we can say, the going on with the, we can say, technological innovation, geopolitical realignment, and the sustainable imperative during the, we can say, and because of all these factors we consider in the we can say the monetary at the international levels, and because of this the continuous, we can say, the innovations where we see at the international level. So the digital transformations are continuously is happening. Now we see the in the recent changes, that is the cryptocurrencies are, we can say, developing at very fast pace. Okay, so maybe in futures we find the payment at the international level, maybe in the cryptocurrency where will be accepted. Now we can say the multipolar reality. Now we can say, now the at the world level, the many of the countries are developing at very fast pace. We can see in back period in the last 75 years, America is the only power in the world. But now in the future, maybe we can say the America, US, India, China, Russia. So all these, we can say the world will be a multipolar. Okay, so that's why the economic power diffusion requires the more inclusive global financial governance. Okay, and because of the we will see the multipolar reality, or the, we can say, the next one is the climate imperative. We see because of the development, okay, we damage the environment, and we can say we damage the environment a lot. So onwards, while doing a business, while doing the international trade, international payment, so we can say think of the climate. So onwards, we can say we think of the, we can say, the sustainable development. So all these will, this is the future of the international monetary and financial systems. So here, the first chapter of the international finance we conclude. If anyone have any questions, you can ask, or otherwise we will sum up the sessions. Okay, so you guys have the 2 minutes. You can ask your questions in the 2 minutes. Okay, if you don't have any questions, then you can leave the sessions. Okay, thank you.